And we're continuing our analysis of Fox Manufacturing here. And so far we've gone through liquidity ratios, activity ratios, leverage ratios, and we're now going to look at profitability ratios. Now, profitability ratios measure the performance of the company. And the way you look at performance at the end of the day is, what kind of profits do you generate? What kind of cash flow do you generate? So profitability ratios are important to a company, and it's important that they generate revenue and income and all those kinds of things. Now, one of the profitability ratios they'd like us to look at, this is called gross profit margin. And this is gross profit divided by sales. And if you go to your income statement for Fox Manufacturing, you see the gross profits. Now, this is revenue less cost of goods sold. And that gives you something called gross profit. And for Fox Manufacturing, gross profit's $140,000. And if you divide that by sales of $600,000, you get 23.33%. That means that every dollar that you bring in revenue, 23.33 cents of that becomes gross profit. All things being equal, of course, you like the gross profit and all these profitability ratios to be what? To be higher as opposed to lower. The industry average is 20.2%. The way you would look at this as an analyst is that Fox Manufacturing's ability to generate gross profit off its revenue is superior to that of the typical firm in the industry. Operating profit margin. Now, this is operating profit, or EBIT, divided by sales. A little further down the income statement here. And again, if you look at their income statement, you see operating profit, or EBIT, is $80,000. So they made $80,000 in operating profit off revenue of $600,000. Indeed, $80,000 divided by $600,000 gives you your operating profit margin of 13.33%. So for every dollar you take in, roughly 13.33 cents of that, becomes operating profit. The typical firm in the industry generates 13.5%. I look at these as being the same. I would conclude that Fox Manufacturing's ability to generate operating profit off its revenue is in line with that of the typical firm in the industry. Net profit margin. This is kind of the further down the income statement now. We're going to use net profit or net income and divide that by sales. And in this case, for Fox Manufacturing, when you look at net profit down there, you find $42,900. So they made $42,900 in net profit off revenue of $600,000. To calculate the net profit margin, you take net profit $42,900, divide that by sales revenue of $600,000. And for Fox Manufacturing, that's 7.15%. The typical firm in the industry has a net profit margin of 9.1%. Now, that is a significant difference. And I would conclude by looking at these numbers that Fox Manufacturing's ability to generate net income off its revenue is below that of the typical firm in the industry. They're not doing that as well as everybody else does. That's something to look at, and this gives you a hint as to what it is that might be out of line with these companies. Return on total assets, also referred to as return on investment, ROI. The logic is that as a financial manager, you go out and you raise debt capital, equity capital, money from whatever source, and you take that money and you invest it in certain things. You invest in the assets of the company. And so the assets are the investments that you make as a financial manager. That's where the term return on investment comes from. ROI, a very common term. I want you to understand that return on investment, return on total assets now, that's the same thing. The definition for this is net income over total assets. So for Fox Manufacturing, net income is $42,900 and total assets is $408,300. So they made $42,900 on $408,300 worth of assets. Net income over total assets, that gets me a return on total assets or return on investment for Fox Manufacturing here to be 10.51%. The typical firm in the industry has a return on investment of 9.9%. Again, this is a significant difference. And I will conclude by looking at this particular ratio that Fox Manufacturing's ability to generate income off its investment in total assets is superior to that of the typical firm in the industry. The last profitability ratio we're going to look at now, this is return on equity. Now, return on equity is probably one of the most widely watched financial ratios, certainly on Wall Street. And because of that, it's probably one of the most widely manipulated financial ratios. And usually if you see a company like this one, whose ROE is much greater than the industry average, it indicates debt, leverage. They use a lot of debt financing. But before we get to that now, ROE, net income over equity, and net income is $42,900. The equity, they tell us total stockholders' equity is $183,300. And equity, stockholders' equity, now that's what the owners have invested into the company. So they're interested in how much income you generate off their investment, ROE. Long ago, I was told that when you see a company's return on equity much higher than the industry average, you shouldn't think good, you should think debt. And indeed, you might recall under the leverage ratios, we saw that Fox Manufacturing uses more debt financing than the typical firm in the industry. The long story short on this, the price of greater return is always greater risk. How are you getting this greater return on equity? You're taking on financial risk. You're taking on bankruptcy risk. You're financing with more debt than the typical firm in the industry. This is return on equity, ROE.